right, I'm going to give it one more minute and then we're going to go ahead and get started. Again, for those of you that just jumped on, I want to thank you one more time for taking the time. We're going to be sharing a lot of really cool information in regards to the buying process, whether you've been considering making a purchase or just want to learn more about what's needed. We're here to kind of answer every questions and go through everything regarding the buying process. So cool. Yes. Thank you for setting this up. Yeah, you're welcome. No problem. Awesome turnout. Thank you guys so much. Sweet. Again, like I mentioned earlier, if you guys have any questions throughout this presentation, the chat is open. Just make sure you send it to everyone so that I can see it as well. We'll be going through some frequently asked questions at the end as well. But feel free to, if you have any questions at all, feel free to throw them in the chat there. All right, I think we're pretty solid. I think we're going to go ahead and get started. Oh, sorry, we got one more that just joined. Okay, and I'll keep adding them as we go along. But once again, guys, thank you so much for jumping on this webinar. Again, like I mentioned, if you're thinking about buying maybe in the next year, whatever your time frame looks like, we're going to go over the buying process and explain everything in a little bit more detail. So I'm going to go ahead and share my screen and we're going to go ahead and get started. Let's see here. All right, can everybody see my screen okay here? Yes, sweet. Let me pop open the chat here. Awesome. Okay, great. All right. Okay. Perfect. Awesome. All right, well, I just want to briefly introduce myself. I'm going to be introducing Alexis as well as Jose. For those that don't know me, my name is Mauricio. I'm a real estate agent with Cobblestone Realty. I've been a real estate agent for the past 3.5 years now, and I've helped over like 100 families find their dream home or their first property. And my team specializes in working with primarily first-time buyers, walking them through everything that's needed in regards to the buying process, things you need to be made aware of, kind of expectations to have. And we love helping people. We love what we do. I want to quickly introduce Alexis. Alexis is a part of my team. She's also a real estate agent here with Cobblestone Realty. Alexis, do you want to introduce yourself? Do you want to say any words?
Yeah. Hi, everyone. Thank you so much for joining us tonight. I am new to Mauricio's team, and I'm new to the real estate industry, but I've been a homeowner for 4 years, and I've helped all my friends find their own homes, and I'm pretty passionate about this process. I, too, was in your position. I was a first-time home buyer, and I remember what I enjoyed about the process and what wasn't so fun. And I'm excited to help you all navigate, finding your home and your dream home and making the process as seamless as possible.
Awesome. Thank you, Alexis. And then I also want to briefly introduce our partnered lender here who joined us today. This is Jose Giusti with the Federal Savings Bank. Jose, if you're unmuted, can you go ahead and say a few words?
Absolutely. Thank you, everyone, for joining us tonight. Again, my name is Jose Giusti, loan officer for the Federal Savings Bank. And just like Mauricio and Alexis, I think we all share the passion of helping people, educating people, and really making the home buying process as stress-free as possible. I think that there's a lot of, for some people, there's a lot of mysteries about the process, but I think that after tonight, you'll get a good idea and a good overview of what that process entails. And it's really not as difficult as some people might think.
Awesome. Yeah, that's so true, man. A lot of people just, they don't know, they're unaware of what's needed, what's expected. And so that's why we're here today, is just kind of walk you through the process and really guide you through everything that you need to know. So without further ado, we're going to go ahead and begin, and I'll hand it over to Alexis.
Yeah. So throughout this presentation, we're going to cover the 5 major steps in the home buying process. The first step is applying for a mortgage and getting pre-approved to buy a home. Once you're pre-approved, you can move into step 2. Step 2 is the fun part. It's the house hunting, finding your ideal home. And then once you find that ideal home, we move into step 3. Step 3 is making an offer and getting that offer accepted. And once it's accepted, we move into step 4, which is the escrow period. The escrow period, there's a lot that happens in that process, and there's a couple people involved, and we'll go through that shortly. And then once that process is done, the final step, everything goes smoothly. The final and we have a closing date. The final step is your closing date and getting the keys to your new home. Now, when we meet with new first-time home buyers or buyers in general, we get the common question of how long does this process, how long is it going to take? And truthfully, there's no set answer for this. There's no set time frame because it depends on the buyer. The buyer dictates the process. So there are some buyers that get pre-approved right away. There's some buyers that they need a little bit of time to work on their credit, pay down some debt.
Maybe save some more money.
Save some more money. Yep. And then once, that's all taken care of, then they can get pre-approved and start searching for their home. So, ultimately it depends on the buyer. The only thing that is set that we really have an ideal time is once you're set and you make the offer and you go through the escrow period, that typically takes about 30 to 60 days, depending on the loan that you get. Yeah,
that's so true. And to Alexis's point, there's actually a lot of people that are involved in the process. It's not just as simple as, you being the buyer, you want to buy a house, you just go knock on that person's door and be like, hey, I want to buy your house, right? There's a team involved with this process. When it comes to buyers, unless you're buying it in all cash, which not a lot of people do, you'll have to get a loan. So you'll have to get pre-approved for a mortgage. So you'll have to get a lender involved in the process. The real estate attorney, you'll need a real estate agent to show you the different options that are available, negotiate the offer on your behalf, and walk you through that process as well. Here in Illinois, every buyer and seller is required to have an attorney present to represent them in the contract. So you'll have to hire a real estate attorney. You'll also need insurance. So every property that you purchase with the loan, lenders will require that you insure the property. So you'll have to get an insurance agent to get you a home insurance on the property. And then you'll also have to do a home inspection. So you have to contract an inspector to inspect the property before you move forward with it. Okay, so that's the people that are involved on the buyer side. In regards to the sellers, they're going to have a team of people that work with them as well. The seller's going to have their own real estate agent that's going to put the property up for sale and negotiate the offer on their behalf. Like I mentioned, the buyer and seller will need a real estate attorney. So the seller was going to have their own real estate attorney that's going to represent them on the process. And then the seller is also in charge of hiring a title company to do the transfer of title, making sure that when the transaction occurs, nobody else can claim that they own the property. It's free and clear to the next buyer. So those are the people that are involved in the process. And so like Alexis mentioned, the first step, and it's really the crucial step, is kind of knowing where you are financially. What a lot of people do backwards, and this happens quite often, is people will go on Zillow, maybe they'll go on Redfin or any real estate website, and they start browsing for houses, and they see a house that they love, right? We get this all the time. People see a house that they love, they reach out to us and say, hey, I love this house. Can I buy it? What do I need to do to buy it? And a lot of times what sometimes happens is they go and try and get pre-approved, and for whatever reason, they may not qualify for that amount for the purchase, or that somebody else who is already pre-approved makes an offer and they lose out on that property, right? So the very first step of the buying process is really knowing where you are financially. So I'm going to let Jose go over the buying process, the step 1 of the buying process, which is applying for that home loan.
Very good. And yes, we do see that many times. And the last thing you want to do is see something that you like and not have that pre-approval ready to go to make your offer. So the very first step is getting pre-approved so that, as Mauricio mentioned, you know what kind of budget you're working with, what type of loan you qualify for, what type of programs, because there is, quite a few out there. So we're going to talk a little bit about that process now. As far as The actual documents that you will need, they're pretty standard across the board anywhere you go. That's going to be your last 2 years tax returns, last 2 years of W-2s. But here in the slide here, the very first step is, there's 3 things that the banks look at when you're applying for a mortgage. That's credit, your credit score, income, which will determine, and you'll see that an example of that in just a bit, of how that all dictates how much you qualify for, and then assets, which is for the down payment. Probably that one being the least important, simply because there are programs out there like the popular IDA, the down payment assistance program that the state offers, which we'll also touch on in just a bit. So we'll go ahead and continue on to the next slide to go over the documents that you'll need to get ready. Very good. So 2 years tax return. Sometimes we just need the last 2 years of the W-2s, last 2 pay stubs. We'll need a 2-year employment history, last 2 bank statements, last 2 months bank statements to verify the down payment or part of that down payment. Some people do get gifts. We'll talk a little bit about that. And then of course, a photo ID. With these documents here, we'll be able to go ahead and run credit, start looking at your income versus your debt. And then, determine what loan options you have based on those numbers. Some of the most popular loans out there, you've probably heard FHA, conventional, VA. We also offer those IDA loans, which are the State of Illinois Down Payment Assistance Program. And we also do loans for DACA recipients, which not every lender at this time is doing. So probably the 2 most popular ones are going to be the FHA, conventional. And what we're going to do here is I'm going to go ahead and share my screen and kind of give you a behind the scenes, point of view of the bank and what are those numbers that we look at when we're determining how much a borrower or borrowers, if there's multiple borrowers on the application, qualify for. Mauricio, can you confirm that you see my screen on your end?
Yeah, I can see the screen. Can everybody else see the screen here?
I'm gonna try to make it as big as I possibly can. I know some people might be on their phones, but I'm gonna go ahead and just kind of circle this number, which is the number we're going to be talking about the most. That's what's called the debt to income ratio. So this is the calculation that the banks make or do to determine how much a borrower qualifies for, right? And what that calculation entails is how much income is coming in versus how much debt is going out, and car payments, student loans, basically any type of monthly payment that you have, and then factoring in an estimate of that monthly mortgage payment. And you're gonna see how these numbers here shift. And the numbers that you're looking at right now, there's what's called a front end and a back end. So the front end ratio, we cannot exceed more than 47%. Back end, and this is an example of an FHA loan, by the way, back end, we cannot exceed 57. So as you can see there, we're at 41.55. Application, clearly all of your basic information, name, date of birth, social, right? We have Mr. Future Homeowner here, employment information. Then, of course, we look at credit, right? So I know a lot of people out there look at Credit Karma, their FICO scores that the credit cards might offer. I always let everyone know that that's just an estimate, right? Until you have a bank officially pull your credit report, only then will we know what your middle score is. And that middle score, as you can see in this example, it's not your highest, not your lowest, but that middle score. So in this example here, where we have a 675 for Experian, 700 for TransUnion, 626 for Equifax, that decision-making score is that middle score of 675. Now, what is the minimum credit score that you need to have? Middle score, 620 for an FHA loan, okay? So moving on here, moving along to this example. So here in this example, I have a purchase of $235,000. Minimum down payment on an FHA loan is 3.5%. There's your down payment. And clearly that would leave the loan at that amount. Typically, we're going to look at a 30-year fixed rate, right? You don't want a variable rate. But in this example here, I'm also going to show you how that payment is broken down, which is what that last slide had PITI, principal, insurance, taxes, and interest. Principal, interest, taxes, insurance, and you're going to see a breakdown of that here in this example. Again, this is a $235,000 purchase. So on this side here, your first number there is your principal and interest. That's the portion of the loan. Your homeowner's insurance. So once you find the actual property, you'll go ahead, you'll call, the insurance companies and get a quote depending on the size of the home, what type of property it is. That'll determine how much your monthly premium is. In this example, it's usually for a single family home is going to be anywhere between $65 to $80 a month. Now here's a number that is very important. This is your real estate taxes. And you're going to see how this number plays into that debt to income ratio that I started off with here. So I'll go through that example in just a bit. And then there's also mortgage insurance. So everyone typically pays mortgage insurance unless you're putting 20% down. Not so many people are putting 20% down. So what mortgage insurance is, I explain to the clients, it's an insurance policy for the banks where if the borrower does not pay, the banks recover their money. So everyone pays mortgage insurance, right? So in this example here, we have principal and interest. You have your homeowner's insurance, property taxes, which at the time I am calculating at $4,800 a year, right? $400 a month. Your mortgage insurance, and in this example here, that gives you your monthly mortgage payment. You're also going to see how the property taxes has a direct impact on that mortgage payment. So let's say you find a $230,000 or $235,000 property, but the taxes are $6,000 a year. Well, clearly when we change that number, not only does your monthly payment go up, but as you can see back here in this example, the debt to income ratio that I circled, now we've exceeded the 57%, right? So then what needs to happen in this scenario is then we have to lower the purchase price, or vice versa, right? If the property taxes are lower, then we're able to bump up that 235 maybe to 240, 245. It's really all about this number here, that debt to income ratio. And that's why I always like to go through this at the pre-approval stage with the clients so that they understand how that affects and how that number can change, because a $235,000 purchase for taxes of $4,800 is very different than maybe a $235,000 purchase with property taxes, say, for $7,000, right? Another thing I just want to quickly show here before we move on to the next slide is your debt, how your debt plays into that number as well. So in this example here, we have someone with a car loan, some credit card debt, which the payment that's reporting on the credit report is usually on credit cards, you're going to pay the minimum payment. But I'll give you an example here. So, I bumped up the property taxes. As you can see, we're at 58% here now. We're over. So then maybe an option is to pay down debt. So I always look at the highest payment. Maybe the car can't be paid in full, but maybe this loan, if I check that off, you'll see that that percentage starts going down. So now that percentage went down to 55%, right? So I always like to go through this example so that people understand. We get a lot of people asking, well, how much do I need to make to qualify for a loan? It also has to do on your debt. And that's why it's always good to start, again, this is the very first step so that you can put together a game plan, know how much you are pre-approved for or potentially pre-approved for. And at that point, know whether or not you need to pay down some debt, to get you where you need in terms of purchase power. Okay, so I'm going to go ahead and get back to the slide. Now, one of the things that we do, you can go ahead and put the presentation back up, Mauricio. One of the things that I do is that we make things very easy for our borrowers. So I actually have an app. Everything that I just did in that example, there's an app that you'll be able to download once you're pre-approved, because it's a lot to remember, right? You're not going to know where those percentages are. But the app makes things easy for you, because as you start your home search, you'll be able to plug in the purchase price, the property taxes, and not only will it calculate your monthly payment, but it'll also tell you if you still qualify based on those debt to income ratio percentages, which is a great tool to have. You're able to go ahead and issue yourself a pre-approval letter on the spot. So does your agent. So it's a very cool tool that we offer that really makes things easy, so that it takes kind of the the guessing away of whether or not you can still, qualify for the loan for that specific property that you're looking at.
Yeah, and the nice thing about the app, Jose, if you don't mind me chiming in here, if we ever run into a scenario where, especially in the market that we're in today, things are kind of moving fairly quickly. So if we don't have everything ready to make an offer, there's a chance that we may miss out. So the beautiful thing about the app too is that it can issue out the pre-approval right then and there, and we can write the offers, within minutes from that. So it definitely helps us stay ahead of the competition in that sense. So
For sure. And you've used that many times to your advantage to
definitely
secure the offer for the borrower.
Cool. So I'm going to go ahead and go on to the next step. Step number 2 is searching for your ideal home, and I'm going to go ahead and let Alexis touch base on here.
All right. So you've been pre-approved, and you have an idea of what you can spend on a home. Now the fun starts, and we can start searching for a dream home. Before we go and see places, myself or Mauricio would sit down with you. We would narrow down ideally where you would like to live, what location, what type of property, single family home, condo, townhome, multi-unit, and how many beds, how many baths, and like must-have such as maybe you want a house with a pool, maybe you want a house with 2-3 car garage or no garage. You would like just a lot. And then last thing is your time frame. So maybe you're renting and your lease expires, within the next 3 to 6 months, or you're relocating, from a job, and you need to be in a home by a certain date. So we ask all those questions, and we work, within your needs and your wants and your time frame to get you your home. And then, so since COVID, there's been a slight change in things when we're searching for your home. So, your realtors will make the appointments based off of your availability. We'll go and check out the homes. Before, we could show up, we could go, we can get in there, because COVID, we are practicing social distancing. Appointments are for just the realtor and the client. They're the only ones going through and getting a tour of the homes. So you don't have to worry about multiple people being in the home. We do wear our masks. If you would like, you can wear gloves. I've been showing homes lately, and they're having, customers don't need to wear, or clients don't need to wear gloves, and the homes don't require you to wear gloves, but it's your preference. Couple of homes do have a requirement of just the agent and the client, or they can bring one other person, but typically it's a max of 3. They are now offering virtual tours and video walkthroughs of the home. Sometimes the homes are occupied and maybe they don't feel comfortable with us walking through just yet, and so they do offer video walkthroughs.
Yeah, and one way we can do that with our potential clients is we'll get on a Zoom call just like this on our phones, right? And we'll walk through the property, point out different things that we notice in the home, just to make you aware of things. And obviously, if you like what you see during the video walkthrough, we can still schedule an in-person appointment for you to view the home if that's what you would prefer.
Mm-hmm.
So like Alexis said, we'll go out, and the search process can really take as long as you need to. We've worked with some clients where, they see 2 or 3 different options and they fall in love with an option and they make an offer, right? And we've worked with other clients where, we see 10, 20, 30 different options, and you're really dictating the pace on how that search is going to go. So it really comes down until you find the home that you feel comfortable moving forward. And once you do, we go ahead and go into the next step, which is making an offer on that particular property, right? So there's different things that we do to negotiate the offer to our behalf. There's different terms that we can present to make it a favorable offer to really everyone. But one of the most important things that we want to look at is we want to look at the comparable properties, meaning the houses that have sold in that neighborhood that are similar, right? If you're looking at a 2-bedroom, 1-bath house, we want to look at other 2-bedroom, 1-bath houses in that particular area to see what they're selling for, right? See the condition. Is it better condition or worse condition than the property that you're thinking about buying? And then we use what that property sold for to kind of get an idea of what this property would essentially sell for, right? Another thing that we have to kind of take into consideration is market time. Right now, and if any of you have already started your browsing, maybe you've been on Zillow or Redfin or any other real estate website looking at houses, you may have noticed that a house hits the market one day and then 2-3 days later, it's under contract, it's pending or contingent, right? Because houses are moving very quickly, there's low inventory. Some of the new houses that hit the market, we don't have a lot of leverage to negotiate a lower price per se, but there could be other terms that we can negotiate in our favor. On the flip side of that, if a property has been on the market for 60, 90, 180 days, there's a good chance that there's not a lot of people looking at that home. And that gives you a little bit of leverage to maybe negotiate a lower offer or maybe ask for closing credits. And I'll have Jose kind of touch on what closing costs are so that we can explain how the credits are used. Jose, can you just briefly touch base on what closing costs are?
Yeah, closing costs include a few things. A lot of people think that closing costs are all bank costs, and that is incorrect. Actually, the bank cost is the smallest number typically of the entire transaction. So closing costs include you depositing property taxes up front. The amount of months that you have to deposit depends sometimes on the county. It even depends on what month you're closing. So you might have to deposit 3 months worth of property taxes. You might have to deposit 10 months worth of property taxes. And clearly, the higher the property taxes, the higher the quote unquote closing costs are. So that includes your appraisal. It also includes all of the title fees. Mauricio mentioned earlier the role of the title company. The title company, they're an insurance company. So the title company is ensuring that you are receiving that property or obtaining and buying that property free and clear, that no one's going to come back, 5 years from now and say, I own that property. They also, take care of the plat survey, which ensures, your property boundary lines. They record the deed with the county. So that's their role in the process. And then bank charges are typically anywhere between, $1,300 to $2,000, probably on the higher end. We're on the lower end of that. And then sometimes there is an opportunity to receive what's called a lender credit and maybe eliminate some of those fees. So that is all clearly. And then kind of your bottom line, which is what a lot of people want to know, is like, okay, well, how much money do I need to buy this house? And there are a few things that come into play there, but you're basically adding your down payment, all of those property taxes, title fees, and then this is where the credits start kicking in, right? So if Mauricio or Alexis negotiate a seller credit, typically they're going to ask them for 3% closing cost credit. And then the way you kind of figure out what you're bringing to closing is you add all those things up with your down payment, you start deducting those credits, and then that's where you get your, what you would be bringing to closing, for example, which is much less than what people think. Many people still think that they need $15,000, $20,000 to buy a house. And that is incorrect, especially when you start getting some of these credits. And then clearly you add a little, or you combine that with one of the down payment assistance programs, that can mean that you're bringing very, very little to the closing table.
Thanks, Jose. There are also different contingencies that we will put in our initial offer. The two biggest contingencies being a attorney review and inspection contingency. So meaning that if this offer does get accepted, we move forward through the process and you do an inspection on the property. If something major comes from that inspection where you don't feel comfortable moving forward, you do have the option to cancel and basically walk away and start the process all over, right? Nobody's going to force you to purchase that property. The other contingency that you will also have is a finance contingency, right? So let's say your offer does get accepted and you're moving forward through this process, and God forbid you lose your job, or something happens with the money that you had saved, or something happens with your finances, and you no longer qualify for the loan. Because you cannot qualify for the loan, you're not going to be forced to purchase that property, and you'll be able to walk away from that purchase. Okay, so those are the different contingencies that you'll have on your contract. So we'll put together an offer. We'll put all these terms together and we'll submit it to the seller for them to review. The seller will either counter our offer with different terms. Maybe they'll change the sale price, maybe they'll change the credits, the closing date, any other things on the contract. They may accept the contract the way we presented it, or they can reject the contract if they have another offer that's better terms for them, right? So there may be a little bit of back and forth in negotiations. This can take a couple days if needed. But as long as everybody's in agreement on that contract and all the terms on that offer, everybody will sign that contract and we will have an executed, accepted offer. So once we receive that offer, we move on to the next step, which is the escrow period. Alexis, I'll go ahead and let you handle this one here.
All right, so the escrow period. Once the offer is accepted, then you have 48 hours for the earnest money deposit. It's typically mailed, and sometimes they'll do a wire transaction, but it has to be received within 48 hours. And then we schedule the home inspection. That can be done virtually now. And then once a home inspection has concluded, they provide a beautiful little packet with everything that they found in the home that works great, or that could use some repair or just something to keep an eye on. That little packet goes to you, the realtor, and your attorney. Your attorney will review it with you and discuss with you on what you would like to negotiate with the seller on maybe some more credits, or if they can repair some items. And that'll happen between your attorney and the seller's attorney.
Cool. So as long as everything moves forward from that inspection and attorney review period, we'll move on to the next part of the escrow period, which is getting all the loan stuff, right? You were first pre-approved for the loan. Now that you have a property that you're under contract, Jose has to run all the information based on this particular property. So I'll let Jose speak on this one.
Yep. So exactly, you were pre-approved. You went out, you found the home that you loved. You made an offer. Your offer was accepted, and now the actual loan application starts, because now we have an actual property and we have some exact numbers in terms of purchase price, property taxes. As you saw, it was important. So we like to keep. I like to have all of my files ready so that when you find the home, it should just be a matter of updating some things, maybe a couple of pay stubs, bank statements. A lot of the work is done on the front end, so that it just makes your whole process and everything just much smoother. At that point, we go ahead and the bank orders an appraisal. So the appraisal will determine the value of the home. So if they're selling you a home for $235,000, the bank wants to make sure that the home is worth at least the $235,000. So the appraisal is a very important part of that, because, for example, if the appraisal comes back lower, let's say it comes back at 230, typically then at that point the attorneys have to agree on lowering that price, as long as everyone agrees to that. And then on the other end, if it comes back higher, then that's great for you, because then you're moving into the home already with equity. So at that point, we prepare the documents. We have everything ready. The loan goes through what's called a conditional approval, which is the first approval, which is done in the underwriting stage. And then once we get our conditional approval, we might need to update a few things. As long as that appraisal comes back at least that value, and that no repairs may be needed, depending on the type of loan and the condition of the property, then at that point, once we have that, we send the file for the final approval, and that's when you receive what's called your clear to close, meaning that the loan portion is done. You have been approved for the loan, and now it's just a matter of having the attorneys coordinate that closing date and time with all parties.
All right.
Yep. So after you get your clear to close, typically before your closing, you're going to do the final walkthrough with the agent. You guys hear me?
Can you hear me?
I can hear you.
Awesome. So like Jose mentioned, the final walkthrough is done either the day before closing or the day of the closing, maybe the morning of. And we just want to ensure that the property is in the same condition that you agreed to purchase it in, right? If the seller had to do any repairs or any modifications to the home, that those were done prior to the closing. So as long as everything's cool during the final walkthrough and there's no issues, and the attorney scheduled the closing, you'll move on to the final step of the home buying process, and that is the closing. I'll let Alexis touch base on this one.
Yeah. So for the closing, it's usually done at the title company. Now, because of our current situation, pandemic, closings are done a little bit more intimately. Sometimes the realtor can be with you and the lawyer. But typically I've seen right now, you're signing documents, you're with your attorney at the closing, and it's just you and the attorney signing documents. Or in some situations, they do it curbside where you're in your car or doing things, or you're signing them electronically from your home. And then they also do one last verification of employment. And once all that is done, you are officially a homeowner and you get your keys and you are ready to move in. And that's the most exciting part. A lot of times with this closing process, people tend to think that your relationship with your loan officer and your realtor is done. Like they're done, they've already helped me. But we keep in touch. You're gonna get a ton of mail regarding loans, and it can be confusing. And so Jose is still a phone call away or a text message away, email away, and saying, hey, I got this mail talking about my loan. They can get me a better rate. Is this true? Is this possible? And he will, he can answer that for you. You're a homeowner. You're going to run into some things that, you're not familiar with dealing, or you need an extra pair of hands. And so that's where Mauricio and I come in, and we can refer you to some great handy people, some lawn care people, and maybe you want an interior decorator to get some help. And we have a plethora of people who work in all those separate industries, and we can provide you with referrals.
Yeah, awesome. All right, so what do you do now? Right now that you have all this information, what do I do? How do I get started? What do I need to prepare? Right. So the first thing that I would do if you're thinking about buying, whether it's going to be in 3 months, 6 months, or a year, 2 years from now, keep an eye out on the market. More specifically in the area that you're considering buying, right? If you're thinking about buying a single family house, look at what single family houses are selling for in that particular area. See how the value has changed over time, and see if it makes sense for you. One thing to always consider as well when you're making a home purchase is to consider the resaleability, right? You may not plan on living in that home for forever. It may be your starter home and you may upgrade in the future, and so you want to think about the resaleability. How easily will this house resell in the future if I need to resell it? So we'll look at all that as well. Look at properties that have sold, properties that are under contract, and look at active listings that are on the market, how long they've been on the market, what type of activity you're seeing in that neighborhood, and kind of get your search kind of going that way. But another thing that you can also do is find out where you stand financially, right? Maybe you don't want to buy a house just yet, but what you can do is you can start creating a plan for when the time comes. Maybe your credit score isn't where it needs to be, or maybe your assets aren't where it needs to be, and you need to save a little bit more money. Having a plan now will help better prepare you for when the time actually does come, that you're ready to make a purchase. And one of the biggest things that we always get asked is, or I guess one of the biggest struggles with a lot of people that want to buy a house, they may have the income, they may have the savings, but they may not have the credit score needed. So I'm going to let Alexis touch base on different tips and different things you can do to help manage your score, manage your credit, and hopefully build on that credit so that you can better prepare and qualify for better financing and better loan options.
Yeah. So here's just a couple of tips that we came up with, and Jose, when you work and talk with Jose, he will provide you with the same tips if your credit just isn't there. So first thing, limit the number of credit lines that you have. Keep your credit card limit as low as you can. Try and keep that 30% and under. Pay what you owe. Pay attention to payment due dates. Try not to miss a payment due date. Keep your contact info current. Always have an emergency fund, and then know what you owe. Okay, that'll help.
Perfect. And then the last slide we have for everyone here is some of the frequently asked questions. Some of the things that, a lot of people, these are the questions that we get asked pretty frequently. So we figured we'd put them all together. We're also going to read through some of the questions that you guys have sent us. All right, first question is, do I have to be at my current job for 2 years in order to get pre-approved? Jose, what's the answer?
The answer is no. And that is one of the biggest misconceptions out there, is that people think that they have to be at their current job for 2 years or more. What the bank needs is a 2-year history. And the only exception to that rule will be, for example, a college student, right? College student went to college, just graduated, just started their career. That would be the only exception, because clearly there's not going to be a 2-year work history there, but we'll be able to document that the borrower was in school. So the answer to that is no.
Awesome. How long does it take to buy a home? I think we kind of touched on that a little bit, right? There is no set timeline. This can take as long as it needs to. The only timeline that is kind of set in stone is once you do have an offer that gets accepted, from the time your offer gets accepted until the time you close on that particular property, you're looking at anywhere from 30 to maybe 45 or 60 days. Okay. How much money do I need to have to qualify?
So that's another one that I kind of touched on a little bit earlier. As you can see, it also has to do with your debt, right? There really is no, people who make $20,000 a year can qualify for a loan. Maybe it's less if they don't have any debt. I've seen people who make 6 figures that don't qualify for a loan because their debt to income ratio is too high. So yes, the income does matter, but your debt also plays a huge part into that debt to income ratio calculation that determines, as you can see, how much you qualify for.
Awesome. This is a good one. What if I'm self-employed? What do I need if I'm self-employed in order to buy a house?
So if you're self-employed, you're definitely going to have to show that you've filed your business tax returns for 2 years minimum. You get what's called either a 1099, or most self-employed borrowers do what's called a profit and loss. It's called a Schedule C on the tax return. But that's probably the most common documentation for a self-employed borrower. So 2 years. 2 years is what you need to show as self-employed, and that includes part-time income as well. It has to be shown for 2 years if you're using that to qualify.
Perfect. Do I need 20% down in order to buy? I think we kind of touched base on that as well. It's a common myth.
Right. That's another common myth. As you can see, 3.5 for FHA. For some conventional borrowers, it could be as little as 3% down if they qualify.
Awesome. Does child support or pension count as income to qualify?
Yes. Couple of things there. Clearly, you have to disclose that and want to use that as part of your repayment, income for repayment. So child support can be used as long as we can show that the child support is going to continue for 3 years or more. So clearly, if you have someone who has a 17-year-old, right, in that case, the child support won't be able to be used because it's not going to continue for 3 years or more. And then as far as Social Security or pensions, yes, that all counts as qualifying income.
Awesome. Okay. Can I buy a house if I've had a bankruptcy or foreclosure in the past?
Yes, and we mentioned the two different types of loans, more common loans, FHA and conventional. FHA is a little more lenient with things like that, so it depends. It has to do with how much time has passed. So for bankruptcy, usually with FHA, you have to wait 2 years from that discharge date. In other words, when it was completed, not when it started, but when it was discharged. And then for foreclosures, kind of the same thing. They each have their own waiting periods, 4 years for FHA, 7 years for a conventional. But I do run across many borrowers who maybe, bought years ago or before the crash, and, they lost their homes just like many other people did. And they think that they cannot qualify for a loan, and that is incorrect. So another myth.
Awesome. Can I use my 401k or retirement savings account for a down payment?
Yes, actually, your 401ks. That's one of the reasons that they'll allow a withdrawal is for a purchase of a home. Sometimes, if you have the option, every 401k plan is a little different. But if you have the option of taking out a loan against the 401k, that might be the better route, better way to go, just because you might save some money in paying taxes.
Cool. Okay. How many people can I include in the mortgage application? How many co-borrowers can I have?
There can be a total of four. So, I showed you the example with the income, right? So if people don't qualify for the amount that they need, another option might be to add a co-borrower so that we can go ahead and add more income. But I always explain to clients too that you're adding their income, you're also adding their debt, right? So it's kind of, it's got to be a balance there where you're adding income. Clearly everyone has debt, but that'll all be, factored into that debt to income ratio as well. So you can have up to 4.
And another question in regards to that one, when you have multiple people applying for the loan, you use the lowest person's credit score, right? Their middle score to qualify?
Correct. So if 3 of them are over 700, the 4th one is in the 6s, the banks, and this, by the way, this works the same everywhere. So it's always going to be the middle score of the lowest score when you have multiple borrowers.
Got it. Perfect. How long does it take to get pre-approved, and how long does the pre-approval last?
Well, a couple of things with pre-approvals. I mean, if I have all of the documents, if I have a complete file, all of the documents you saw earlier, W-2s, work history, depending on how, there's different types of income. So some people get paid hourly. In the case of hourly, I always like to order verifications of employment just to make sure that the hours are steady and that we calculate that qualifying income correctly, because as you can see, those percentages make all of the difference. When it's salary, that's probably the best case scenario because salary doesn't change, right? So it's pretty easy to calculate. But if I have a complete file, all of the documentation, I mean, once I have a complete file, it'll take me 15, 20 minutes to issue a pre-approval letter. But again, every case is a little different. Sometimes, I've had borrowers that might have had, 4 jobs over the last 2 years. So then at that point, we have to wait for all those verifications of employment to come in. And, I've had some that might take a week, week and a half for all of them, because you're depending on third party, verifications. So it all depends. But if we have a complete file and everything is verified, it can literally take 15 minutes to get a pre-approval letter. And then how long does it last, or how long is it valid for? Typically 90 days, because after 90 days, we have to re-pull credit again to refresh that credit and make sure that nothing's changed in terms of the credit.
Perfect. What's better financing, conventional or FHA?
That is one of the biggest questions, most common questions that I get. And my answer is whatever works for you, right? So not all files are created equal is what I say. And, for an FHA, again, I mentioned a little bit, kind of generally speaking, FHA is a little bit more lenient with things like credit. We talked a little bit about the bankruptcies and things like that. Conventional is a little more strict with those things. So it all depends. That's why the pre-approval process is so important, so that we can look at that and then kind of see what your options are, where you fall in. I do everything that I kind of showed you is what I do at the pre-approval process. And then if, some clients might qualify for both, and then you just kind of break down the numbers. And, at the end of the day, whatever works for you and whatever's going to help you get into that home is the better loan, because at the end of the day, it's all money, right? So just different types of loans, they have their own requirements. So whichever one works best for you is the better loan.
Perfect. And then the last question I have here before we go on to the questions that people have asked us is, what are my closing costs? What does that look like?
So we talked a little bit about that a little earlier, right? The property taxes, title fees, your down payment. So all those things are played into that, play into that number. So not every case is the same. I know I've had a client the other day tell me that his friend told him that, it was so much. By the way, that's probably something I should definitely touch on, is make sure that if you're getting advice, come to us, because there's a lot of bad and incorrect information out there, and people start paying down debt sometimes and they didn't even have to do it. They could have just saved that money, right? So there's, a lot of people go based on what family or friends tell them, and many times it's not correct. So I would say, come to us, come to me, because I'll be able to see your profile, your borrower profile, and tell you exactly what it is that you need to do, whether it's pay down debt, whether it's save more, right? That way, for sure, whatever game plan we put together is what's going to get you in that home. So closing costs can vary. Property taxes is the biggest number that can change, right? So if you're depositing 10 months of worth of property taxes, and property taxes are $500 a month, well, then that's $5,000 in closing costs, right? But the same way that the borrower is depositing property taxes, the seller did the exact same thing when they purchased their property. So you get what's called a tax expiration credit. So basically, for example, right now, anyone who is selling their home, they lived in their home from January 2020 through November of 2020. So you'll get 11 months worth of tax expirations. But that also depends on the county too, because Cook County taxes, the tax bill comes out differently than like DuPage or Kane. But at the end of the day, that's all part of your closing costs.
Perfect. So we do have some other questions that people put here in the chat. Is a bonus in income factored in when applying for a loan? So if somebody gets like an end of the year bonus or a quarterly
Yes.
bonus, how is that factored in?
As long as you could show it for 1 year. So it does place. Overtime also plays into that number, as long as you can show that the overtime has been consistent for 2 years and that the overtime is not decreasing, right? So like if you work more overtime last year and you're working less this year, then the banks will always take the lower number to use, for qualifying income, right? Because the main thing is consistent income is what all lenders are looking at. So bonus can be used as qualifying income as long as they can show that they've been getting it for a year.
Perfect. And then Jose, can you clarify on this question? It says, can the pension be used for the down payment?
It sounds like maybe that question is like a pension, like a retirement fund. Yes.
What does it
Yes.
mean?
Now,
I'm sorry, does it mean it would be encouraged to get a 401k to save for the down payment, or is there a penalty for using a 401k as your down payment?
yeah, no, you don't need to get a 401k to save for your down payment, but many people, if their employer offers these 401ks, well, if they're contributing to that and they've, been at the job for a while and they have, a few thousand saved up, they have that as an option to withdraw to use for the down payment. So that's why I mentioned a little earlier, if you have the option of taking out a loan, probably better, because if you withdraw, you'll still have to pay taxes on it. You won't pay the penalty, but you'll pay taxes on that money. Whereas if you take out a loan, typically those 401k loans are, 1 or 2%, and then you're just borrowing against it. They take it out of, your check every paycheck, and then you're done. You've paid it back and you're done. There's no taxes to pay.
Perfect. Here's a good question. What are the main differences between a first-time buyer and a second purchase?
Well, that all depends. Like for example, the state of Illinois changed that a couple of years ago, where the down payment assistance was only available to first-time home buyers. That is no longer the case. So now if you have not owned a home for 3 years or more, you'll still qualify for that down payment assistance, right? Now, if that question changes a bit and you already own a property and you're trying to buy another property, then at that point, it depends on a couple of things, because then that second property might be looked at as an investment or a second home, which then typically is going to require a higher down payment for that property.
Awesome. Okay. I've got a question here for you, Alexis. What happens if the home inspection goes horribly wrong and the seller doesn't want to fix anything or provide any additional credits for the issues? What would be the scenario?
Yeah, so ultimately it's up to you as the buyer if you want to back out. And at that point you could back out. Correct me if I'm wrong, Mauricio, you would be able to retain your earnest money back.
That is right. Yes. As long as it's done within the contingency period. So as long as it's done within the attorney review, that earnest money gets returned to you because the deal did not move forward. The other side of that is, I mean, if you have the inspection list and you know what's wrong with the property, you have the option to move forward if the seller doesn't want to fix anything, right? Again, it's totally your choice, but you can either cancel or you can move forward knowing that you're going to have to probably fix these things on your own in the future. All right, what's an ideal credit score for the lowest possible loan? I'm assuming it's for the lowest possible interest rate. Is that what the question is?
Probably the lowest, the minimum score to qualify for a loan, the middle score would need to be 620.
620, okay.
Yeah. And that can change too. For example, after the pandemic, I believe US Bank raised their minimum score to 680. So some of the banks that you see in every corner have what are called overlays, so there's guidelines, and those banks are typically a little bit more conservative. So they have kind of their own rules on top of that. It all depends, but like for the Federal Savings Bank, it's 620. It used to be 600 before COVID, but then there was a few changes in the lending world that raised those standards, but 620 is still pretty low.
Okay. Here's a question. How do the first-time buyer grants fit into this equation? What do you need to qualify for the first-time buyer grants? What are they? How do they work?
Right. So again, state of Illinois doesn't require that you're a first-time homeowner anymore, but 3 things that the state of Illinois looks at to qualify for that program. You have to have a minimum credit score of 640. There's also income limits. So each county has their own income limit. So for the most part, they just raised it last year. It's $106,000, and that includes all borrowers. So if there's 2 borrowers in there and they each make $60,000, then they're over the limit. And that's usually where people don't qualify for the program. It's not that they don't have the credit score. It's not that they're not a first-time home buyer or they haven't own a home in 3 years. Some people exceed that limit. And what I always explain to borrowers is you have to remember that these programs are designed for low to moderate income. So if you don't qualify for them because you make too much money, it might not be a horrible thing, right? So, but those are the things that the state looks at. And then going back to that debt to income ratio that I talked about earlier, the state caps you at 45%. So the example that we looked at was at up to 55, which is what a traditional FHA loan would allow you to go up to on the back end, 57, up to 57. The state caps you at 45%. So then I guess the kind of the downfall there is that you're going to qualify for less money possibly with that grant. But again, every scenario is different and the program might be perfect for you. It might not be, right? So every situation is different. That's why it's very important that you start with the pre-approval process. Even if you're not ready to buy, next month or 3 months, just so that you know where you stand and start putting together that game plan so that whether it's 3, 6 months from now, 12 months from now, we have you in your home.
Awesome. So here's a good question. It says, my friend was told that she was not approved for the loan because she didn't have enough debt. What should people do if you pay your credit cards in full every month and you've paid off all your student loans? Is that? What's that look like?
It sounds to me like maybe that person didn't have enough credit history. That's probably it. Because I mean, you should never be penalized for not having debt. Now, what happens, and I do see on credit reports, is that if you have everything at zero and you haven't used it and it's inactive, there's times where then they're not reporting that. So I've had cases where people just maybe opened up, some credit not too long ago, but it hasn't been active and it won't register a score. So it sounds to me like that's probably what happened in that scenario.
Okay. And then the last question I have here is regarding student loans. How does student loans affect somebody getting approved for a loan?
Great question. And that's another thing that we see a lot. So it depends on the type of loan. So even if the student loan is deferred, which we've seen a lot of that clearly post COVID-19, for an FHA loan, we have to use 1% of the balance as a payment. So even if you're not making a payment, even if it's deferred, for qualifying purposes, we have to assign 1% of that balance on an FHA loan. On a conventional loan, it's 0.5%. So that's the way the student loan. Now, if it's an installment loan, like if you have an actual loan where the payment is the same every month, and after 5 years you're done, well, then that's the payment that's used, in that debt to income ratio calculation that we saw a little earlier.
Perfect. All right, we got two more questions that came in. What are some first-time homebuyer credits that one should be looking out for? Does it vary depending on the mortgage lender?
So the down payment assistance program is pretty black and white. There's 3 versions that the state offers. So the first one is 4% of the purchase price up to $6,000. That one is forgivable as long as you live in the property for 5 years or more. Second version of that is up to 5%, maxed out at $7,500, and that one is deferred, meaning that whenever you either sell the home or refinance the home, you have to pay the state that money back. And then the third one, which in my opinion is probably the best one, just because the third one is 10% up to $10,000, and that one is basically a $10,000 loan at 0% interest, which is, you're not going to find a loan at 0% interest anywhere. And then that one is automatically included in your monthly payment. After 10 years, you've paid the state back their $10,000, and that is it.
Awesome. We got some more questions. So it says, what happens if after you close on the property, you find prior damage after already moving in? So every seller or every homeowner, when they sell a property, they have to disclose everything that they know could be a potential issue with the property. There's disclosures that they fill out, and you as a potential buyer are presented those disclosures, and you have to acknowledge that you received those disclosures. So if the seller did not disclose something and maybe they knew that there was an issue, there could be grounds for maybe a lawsuit, right? That would be a attorney question. But a lot of times you may, sometimes things come with homeownership. I'll give you an example that happened to me when I bought my house. So me and my wife bought our property a couple years back, and we bought it, I think it was like maybe April or May. And I think 2 or 3 months after, we bought a renovated house, so it was fully remodeled. And 2 or 3 months after, we got a pretty heavy rainfall and our basement flooded. And our basement had carpet in it, right? So the inspector, unfortunately, was not able to inspect the foundation walls or anything because there was drywall already. So, at that point, there's really not much that could have been done. It's kind of on us as the owner to kind of take care of those issues. But if it is something that was knowingly undisclosed, meaning the seller knew about it and they did not disclose it, and you can prove it, then that's something that you'd want to deal with the attorney. Okay, here's another question. Why does the pre-approval amount vary depending on the lender, or why are people sometimes suggested to get 2 or 3 different lender opinions?
So as far as the calculations and the guidelines are the same. The only things that vary, I mentioned a little earlier, are some of those overlays, right? So I'll go back to that same example. You might walk into a U.S. bank and you register a 650 score and you don't meet the 680 that US Bank requires, so they deny you, right? You come to me and that 650 gets you a loan. So that's kind of why sometimes they recommend clearly that you look at, in other words, you also want to compare sometimes, rates. Rates, at the end of the day, for the most part, are going to be the same. There's other things that play into the rate. Credit score is a huge part of that, the type of property, right? I saw another question here, and I'll just jump into that one. But a lot of people ask, well, if you run my credit, is it going to hurt me, right? Because a lot of people, that's kind of like usually the hesitation at first is, I don't want you to run my credit score or my credit. For a mortgage is very different than when you're applying for like a credit card. Car loans are the worst, by the way, because when you go to a car dealership, that application that you fill out is sent to 20 banks so that they can get you the best rate. And that's 20 banks that check your credit. And that's where we see the dip in scores, 20, 30, 40 points, right? So for mortgages, it's designed this way by the credit bureaus to allow the client the opportunity to go and maybe check a couple banks and, not disqualify themselves in the process, right? And really the credit check is really important because that's really going to determine where we're at, whether you meet the minimum, whether you need some work, right? And again, the Credit Karmas of the world and all of those other services, they're third parties, they're just estimates. The only way you're going to know what your true middle score is if you have a bank pull that.
Perfect. Well, thank you so much, Jose, for filling us in on all that info.
Absolutely.
Thank you again to everybody that participated